Welcome to the Divorce the IRS Podcast, the retirement income planning podcast designed specifically for those who want to pay the least amount of taxes possible and build a retirement income that lasts. Inspired by the best-selling book, Divorce the IRS, you get to go behind the scenes with financial planner, author, and speaker Jimmy Miller. Learn how to set yourself up to pay the least amount of taxes in retirement when you'll need your money the most. And now, here's your host, Jimmy Miller.
Welcome to the Divorce the IRS Podcast. Today we look at one of the biggest myths out there, that you will be in a lower tax bracket someday when you get to retirement. Some people actually will be. I'm not going to argue that. But those are generally the ones who didn't save, and they are, or will be, generally poor in retirement. This probably isn't you, though, someone listening to a podcast like this. So let's get into it. When I talk to people about the benefits of switching their retirement savings from the traditional IRA and the 401k to the Roth IRA and the Roth 401k, or why they probably don't want or need the biggest tax refund possible this year, I hear the same argument almost every time. I'm going to be in a lower tax bracket in retirement, right? Doesn't it make sense to get the tax break now and pay taxes at a lower rate in retirement? Well, in this episode, we're going to discuss this argument and examine some examples with numbers to see what saving and withdrawing in retirement could actually look like. We'll also see some of the tax time bombs in action. First, though, let me address this common argument that you will be in a lower tax bracket when you are in retirement. First, if you've saved and planned properly for retirement, you might not be in a lower tax bracket. For most of the people I work with, they don't want to have less money or lifestyle in retirement than they do now. They want at least the same amount of money they have and live on now. Many want even more. That's because when you're not working 40 hours a week, you usually fill your time with hobbies. You know, those expensive things you like to do with your free time. So if you have the same or more income in retirement than you do now because you've saved properly, you won't be in a lower tax bracket. Second, you may be forced into a higher tax bracket against your will. See, you and me, we don't control what tax rates are set at. The government controls that. And if tax rates increase between now and when you withdraw your money in retirement, which is likely with the current government deficit, you may just find yourself in a higher tax bracket when you get to retirement. A short history lesson using Google will quickly reveal that tax rates for most of American history have been higher than they are right now. In some periods, a lot higher. Another one of the things that makes it harder to be in a lower tax bracket someday that most people seem to miss is that when you get to retirement, the things that really help lower a person's tax bracket are usually gone. See, the kids' tax credits left with the kids. Mortgage interest deductions stopped when the mortgage got paid off. 401k contributions stopped when you stopped working. Health, vision, and dental insurance contributions also stopped. And your Medicare premiums are not even tax deductible in retirement, even when they come out of your Social Security check someday. Employer life insurance contributions are gone. You're not eligible for HSA contributions any longer. The list goes on and on. So now that we're starting to realize all the reasons we may not actually be in a lower tax bracket once we get to retirement, let's discuss why putting your money into a tax-deferred account now, what I call the tax-me-later bucket, and taking that loan from the IRS probably isn't what you want to be doing. Remember, when you put your money into a tax-deferred plan to save money this year, you won't just owe taxes down the road on what you saved. You will also owe taxes on the growth of that money, as we'll learn more about with Tax Time Bomb 3 in an upcoming episode. The IRS will have a lien on your entire account for those taxes, and they will collect. Let's take a look at an example. Let's assume you're single and you make $120,000 per year. That puts you squarely in the 24% marginal tax bracket for 2026 rates. You want to save for retirement, so you contribute $23,000 a year into your traditional 401k at work. The maximum allowable contribution in 2026 has actually been raised to $24,500, but to keep things simple, we'll assume an even $23,000. This will save you $5,520 in taxes each year. And you have a little extra, about $212 in your paycheck every 2 weeks. Now, you probably just spend that little extra from every paycheck, so it has no real benefit to your future. And you will owe taxes on the entire balance in your 401k account someday. Now, let's fast forward. You do this every year for 30 years, and along the way, your investments earn an average of 8%. For simplicity in this illustration, we'll assume you never get a raise, and the amount of your contribution never changes either. Plus, you don't get any match from your employer. Of course, if you did get a raise every year and your employer did give you a match, this example would be compounded. Now, over the 30 years of working, you would have saved $690,000 of your own money into your 401k. That's $23,000 a year times 30 years. And if you're looking in the book, Divorce the IRS, there's a chart that shows how the 30 years of savings looks there. And with the 8% yearly average compounded growth, at the end of your working career, you would have over $2.6 million in your 401k. Now, if you add up all your tax savings, that $5,520 a year times the 30 years you worked, you'd have realized $165,600 in total tax savings. And that's not bad. Most people would love to keep this much money from the IRS, as well as have a 401k balance of over $2.6 million. But you see, the problem is you haven't kept anything from the IRS. You've simply delayed giving it to them. The instant gratification of $5,520 more in a tax refund each year, really a loan from the IRS, will catch up to you. Let's continue this story. Let's assume now, after 30 years of working, you would like to retire. And for simplicity, let's assume that you're also old enough, 59 and a half years or older, to not have any withdrawal penalties on top of the taxes you will owe, which we'll discuss in Tax Time Bomb 2 episode that is coming soon. Now, I imagine you wouldn't take all your money from this account on the first day of retirement. If you did, you would incur a whopping tax bill. I'm also going to assume you follow the widely recognized 4% rule and withdraw just 4% of your account balance each year for income, with a 3% raise each year for inflation. Now, following this rule, in the first year of retirement, you would take out $104,220 from your account. This would actually keep you in the same marginal tax bracket of 24% in retirement, if this was your only source of income, and using the 2026 brackets. But let's assume that the tax brackets continue to rise as they are adjusted yearly for inflation. This assumption would bump you down one bracket to the 22% marginal bracket, and you would have an effective tax rate of about 17% in this future example. This means on the $104,000 you took out of your account, you would pay about $17,800 in federal tax on your withdrawal, plus state income tax in most states. Then in your second year of retirement, you would take out a little more than $107,000, the $104,000 plus a 3% raise for inflation. And if you stayed in the 22% marginal tax bracket, you would have about a 17.3% effective tax rate, owing about $18,500 in federal taxes. Now let's compound this out over a 30-year retirement to see how it all works out. Now, over the 30 years of retirement, you would withdraw a total of almost $5 million from this account, your old 401k. And if you add up all the taxes you paid over those 30 years of retirement as well, you would find that you paid the IRS about $992,000 in federal taxes. Remember, this is just from your old 401k account. Now, do you remember what you saved in taxes over those 30 years of working by putting your contributions into the pre-tax 401k? It was a little more than $165,000 in total tax savings. So my question to you is, would you like to save $165,600 in savings over your 30-year working career just so you can pay back the IRS $992,000 in taxes over the course of your retirement? You see, even though you took all your tax deductions while you were working at the full 22 or 24% tax bracket savings rate and paid taxes back in retirement with a much lower effective tax rate, it still didn't work out for you. Not even close. It worked out really well for the IRS, though. Saving tax deferred while you're in a higher tax bracket probably will not benefit you down the road. It doesn't matter if you'll be in a lower tax bracket later. This is a myth. Even if you do end up in a lower tax bracket, you probably won't be in a low enough tax bracket to ever save a penny on total taxes due to the growth of the tax-deferred account, and thus the taxes on it. The best way to pay less in taxes during retirement is to follow the advice in this podcast early in life and make smart choices now so you can achieve a 0 or very near 0% tax bracket in retirement. Let's take a look at a couple more scenarios using this example just to further illustrate this point. Now, maybe you don't believe you'll earn 8% on average on your investments over time. Maybe you're more conservative than that. Maybe you don't think it's sustainable to take 4% out for income every year and give yourself a 3% raise each year. Let's take a look at what happens in each of these scenarios as well to make sure you completely understand this myth. Imagine you didn't take a raise every year of your retirement. Instead, you just took out a level income of $104,220 per year for the whole 30 years of retirement. You would pay only $17,800 a year every year in federal taxes at an effective rate of about 17.12%, assuming tax rates never increased. Even in this scenario, you would still end up paying the IRS over $535,000 in taxes over the course of your 30-year retirement. That's more than double what you saved in taxes while you were working. Now, let's say you were more conservative and only earned 6% average on your money while saving for retirement. You would end up with a 401k balance of about $1.8 million instead of over $2.6 million. Taking out 4% each year and never giving yourself a raise would mean about $72,700 of taxable income each year. You would only owe about $10,900 of federal tax on this income, which is the 22% marginal and 15% effective tax rates. Now, if you multiply that by 30 years and you pay back $327,400 in taxes to the IRS for the $165,600 in tax savings you had while you were working, you see, it still did not work out in your best interest. And this just considers federal tax. The effect is compounded if you happen to live in a state that has state income tax as well, and 43 of the 50 states do. What if you expect to have other retirement income as well? You see, most retirees will have other sources of income from things like the taxable bucket, rental income, and Social Security. If you add all this to your income, you can see how you probably won't be in a lower tax bracket or pay less tax in retirement. Now let's switch gears and let's look at the truth of the myth. For those who save in life, which hopefully is you, there just isn't any way to be in a low enough tax bracket in retirement to avoid paying more taxes back than you ever saved with tax-deferred investing. Nothing will stop the IRS from collecting that tax either. Even if you pass away, your beneficiaries will have to pay all that tax, and probably more, which we'll discuss in the upcoming Tax Time Bomb 7 episode. The surviving spouse in the relationship most likely won't be in a lower tax bracket when he or she moves to single tax brackets later in the retirement years, which we call the widow's penalty. But it gets even worse. On top of all that, the money you would draw in retirement from your tax-deferred accounts has the potential to make your Social Security taxable as well, and increase your Medicare premiums too. We'll have a whole episode coming up on each of these two tax time bombs as well. When you factor those taxes into the equation, along with the fact that current tax rates will likely one day sunset and then increase, you will probably end up paying even more taxes in retirement than you realize if you don't start planning now. As we talk about the complications involved in saving and withdrawing for retirement, you begin to see that there are many issues to consider to effectively divorce the IRS and avoid paying them more tax than necessary in retirement. Specifically, there are 8 tax time bombs that can explode on you when you least expect them. In the next 8 episodes, we'll discuss each of these tax time bombs and how you can plan to defuse them. Stay tuned and make sure you've hit the subscribe button so you don't miss any of the strategies. See you there.
Want even more ideas, tools, and resources on how to navigate your financial life? Check out all the resources on the Divorce the IRS website at divorce-the-irs.com or the Baobab Wealth website at baobabwealth.com, and subscribe to the blog to stay up to date on issues affecting retirement income planning. Don't forget to subscribe to the podcast so you never miss an episode. Baobab Wealth and Baobab Wealth Abroad are DBAs of Baobab Wealth LLC, a Florida registered investment advisor. This podcast is designed for general education purposes only and shouldn't be taken as legal, investment, or tax advice. You should seek out a qualified tax professional or licensed financial advisor to determine what is best for your personal situation.